focus on our interim results, and I'd like to introduce our presenters to you, our Chairman, Mr. Nicholas Allen, Executive Director and Chief Executive Officer of Link, Mr. George Hong Choi, Executive Director and Chief Financial Officer of Link, Mr. Kok Shun Wu, and Chief Operating Officer, ex-Mainland China of Link, Mr. Bradshaw. Thank you. We now invite our Chairman, Mr. Nicholas Allen, to give an overview of the interim results for the year 2020 to 2024. Chairman, please.
Thank you, and thank you everyone for joining us today. I'm very pleased to have George, K.S. and Greg with me here on the stage. As we dive into our interim results, I'm pleased to share a snapshot of our financial performance with you. Despite the slower than expected retail consumption recovery, our commitment to operational excellence in our capital, asset and portfolio management has yielded a solid set of results. Revenue and NPI rose by 11.3% year-on-year and 10.4% year-on-year respectively, mainly attributable to the stable growth of our Hong Kong portfolio and the new contribution from our Singapore asset. Considering the hawkish rate environment, we managed our capital and financing carefully to cushion the impact on our financial performance. Distributable amounts maintained an uptrend and reported a 1.7% year-on-year growth. The fully diluted DPU on an adjusted basis was still able to register a positive growth of 0.4%. Amidst the tight financial conditions, our balance sheet exhibits financial strength, underpinned by a healthy net gearing ratio of 18% and an interest coverage of 4.3%. We have come a long way since our initial public offering in 2005. Our track record is a testament to our ability to have delivered shareholder value, even during challenging times such as the global financial crisis and the COVID pandemic. Distributable amount has grown at a CAGR of 9.6% in the past 17 years. Our market cap has increased substantially, more than trebling in value to Hong Kong dollars 92 billion from 22 billion at the IPO, benefiting from the high liquidity of our shares. Looking forward, let me go through our market outlook and mitigation measures. Let's delve into the landscape of our markets amidst geopolitical, fiscal and environmental concerns. The global economy is undergoing a radical shift, largely influenced by escalating geopolitical tensions, which have resulted in supply chain reconfigurations. The complexities of these scenarios necessitate a revisit of our operational strategies. Moving to our monetary environment, a higher for longer interest rate, hawkish outlook, poses real challenges for businesses by escalating borrowing costs and negatively impacting property values. Furthermore, increasing frequency of climate-induced disruptions imposes volatility on traditional supply chains, leading to fluctuations in supply and prices. In short, these are treacherous waters to navigate, but they also provide an opportunity for strategic adaptation and resilience building. Hong Kong's economy has withstood the macroeconomic headwinds faced globally. The low unemployment rate is an indicator of the sustained economic recovery thus far. This, in addition to higher minimum wages, are expected to underpin consumer sentiment and thus retail sales. Over in mainland China, the economy is showing signs of finding its footing, although growth momentum is expected to be stymied on the back of a struggling property market. That said, a combination of monetary and fiscal policy tools, such as renminbi stabilisation, as well as infrastructure spending, are expected to cushion the dampening effects from the property sector. The counter-cyclical nature of the mainland Chinese economy, with its benign inflation vis-à-vis the rest of the world, and government support, should mean its growth rate is likely to outperform other markets. Looking further afield, Singapore's recovery of inbound tourism has undoubtedly boosted the growth outlook for retail, thus having a positive knock-on effect on retail rent growth. Domestic unemployment rate remains tight at 1.9% since the pandemic, which is expected to provide some buoyancy to consumer sentiment. While these paint a rosy picture, it is worth remembering a caveat that the Singaporean economy is still highly exposed to external factors. Meanwhile, in Australia, population grew at over 2% year-on-year, which will translate into growth in the retail sector. In addition to this, tourist arrivals rebounded 23% quarter-on-quarter in the third quarter of 23 to 4.9 million visitors, which provides an added impetus to the retail sector, particularly to centres located in city centres. Against the challenging macro backdrop, our multifaceted approach in mitigating risks underpins our strategic resilience. Our retail and car park portfolios stand out as stalwarts of stability thanks to our experience derived from years of operational excellence and focus on non-discretionary consumption. Financially, our proactive approach to hedging and cost-efficient capital management fortify our balance sheet. Despite these, our intention is to avoid complacency and to evolve. The desire to transition to an asset-lighter approach not only helps to build an additional stream of steady income, it's also a way forward to grow AUM whilst protecting the balance sheet from value erosion due to higher for longer interest rates. Let me now pass on to Greg to share more on the operational excellence and updates.
Thanks, Nick, and good afternoon, everyone. So we're taking active steps to enhance our integrated operating platform with the aim to elevate operational efficiency, increase productivity, and to drive tenant customer satisfaction. In achieving these goals, one of our core strengths, which is our operational capabilities in real asset management, really comes into play. This is crucial in maintaining a steady cash flow and propelling organic growth. They're also key in supporting our Link 3.0 strategy, which is the roadmap leading us into further growth. Therefore, this foundation, our focus to operational excellence, not only institutes a solid foundation for steady organic growth, but also allows us to drive scale and reach. Now we'll just have a quick look at some ESG updates, where we've identified 4 strategic areas across our portfolio over the next 5 years. Reducing our carbon footprint and reinforcing climate resilience remain our priorities. Early this year, we submitted science-based target net zero packages for validation, and we're very pleased to announce that we are an early achiever within Asia Pacific for attaining the SBTi validation in line with their net zero standards. Along with our net zero 2035 commitment, this demonstrates our capability in upholding international best practices and our investors' expectations. We also completed a comprehensive energy audit across the entire mainland China portfolio, and this has identified significant reduction opportunities over the next few years. Lastly, we're now finalising our ESG data management system for better transparency and accuracy to support our future reporting and auditing. Our sustainability leadership aligns with global and industry best practices, as manifested by our improved 2022-23 ESG indices performances, as shown on the screen here now. GRES, it's our first year reaching 4-star rating, where our score improved more than 10% from 79 to 87. Now I'll touch on some operational updates. First, I'll draw your attention to general trends observed at our retail assets. In Hong Kong, retail reversions proved to remain stable through the various economic cycles. This has included withstanding unprecedented pressures and uncertainty brought by the pandemic. Broadly speaking, high occupancy rates were sustained across all our operating markets. While this is a testament to our properties as desired locations to tenants, it would have also contributed to the ability of our tenants to recover very pleasingly to their sales at pre-COVID levels. Adding to this stability is the adjustment of car parking tariffs on an ongoing basis. Now we'll just shift to Hong Kong and our retail segment, which has continued to demonstrate ongoing resilience. The numbers achieved speak for the relevance and quality of LIC's portfolio of tenants. Occupancy rates were maintained at their all-time high of 98%. Rental reversion was the highest it's been since COVID, growing at 8.7%. Correspondingly, these have tied in with the average unit rent exceeding pre-COVID averages, now at $64.30 per square foot. And now we'll look at more detail as to what drove performance via our leasing activity. With more than 300 new leases being signed during the first half, and the introduction of new brands were undoubtedly part of our initiatives to keep our portfolio relevant. And these accounted for nearly 40% of the new leases undertaken during the period. The top 5 retail trades listed here on the slide are a curation of trade mixes reflecting current consumption patterns here in Hong Kong. Tenant sales performance was broadly positive at 3.1%, and breaking it down by trade mix, food and beverage continued to lead the pack, growing at a solid 9%. Although supermarkets and foodstuff continued to underperform, general retail notably contributed, growing at 4.7%. And overall, this helps to explain the normalisation in occupancy costs at a very sustainable 12.4%. As a provider of social infrastructure through our car parks, which also complements our retail assets, there is also an additional pull factor for customers, which is the increasing provision of EV charging positions throughout our portfolio. Compounding this is the structural shortage of car parking space in Hong Kong, and it explains our ability to grow the segment's income at a very steady rate. Revenue from car parks and related businesses grew 5.2% year on year. It's also underpinnings for our valuation uplifts of these assets, and the average valuation per parking space increased 1.7% year on year to $737,000 per space. Enhancing value of our assets is part and parcel of our DNA and has been for some time. Our future CapEx pipeline under planning and statutory approval amounts to over 690 million Hong Kong dollars. Asset enhancements completed or currently underway involved combined capital expenditure of over 400 million Hong Kong dollars. The Tung Tau market was completed in the first half of the year with a capital expenditure of 28 million Hong Kong dollars and has yielded a return on investment of 15.9% and is a very good example of the value accretion achieved from these projects. Just touching on the flooding at Temple Mall, where our team demonstrated outstanding operational focus. Within the span of 24 hours, they initiated a swift restoration of these facilities. And after 54 days of accelerated repairs, we proudly reopened the lower ground floor recently on the 31st of October. The rapid reinstatement showcases our strong capability in property management and also demonstrates the collective power of our staff and our stakeholders. Now, ongoing regular facilities assessments are being conducted to protect us against future flooding. Currently, we're also assisting tenants to rapidly resume normal operations post the incident. The recent Hong Kong government policy address introduced an upgraded transport blueprint, 3 railways and 3 major roads, mapping out a pathway to enhance connectivity. The expected growth in foot traffic resulting from improved transport infrastructure represents opportunities for us. The increase in the number of access points will have a positive effect on the development potential of projects which fall within the targeted areas. The Transport Blueprint's railway section spans 3 critical regions which include the northern area, Kwun Tong and Kwai Cham. areas where we have an intrinsic presence via our ownership of 40 assets dispersed across those regions. Our development project in Anderson Road in Kwang Tong is also posed to benefit as it is conveniently located near the proposed route of the future East Kowloon line. And now we'll move on to Singapore. And during the first half of the financial year, our Singapore assets provided their maiden contribution following the financial close of this acquisition on the 31st of March. The assets comprising suburban retail malls Jurong Point and Swing by Thomson Plaza have been fully integrated into our platform. These assets saw robust occupancy, positive reversions, and have registered nearly full occupancy at now 99.3%. Furthermore, AMK Hub has contributed via the way of a management service agreement with its owner, a partnership we're very proud of. In addition, we've opened a new regional office in Singapore in July to better meet our needs as we expand across the Asia-Pacific region. Looking further afield to Australia, where our retail portfolio there continues to appeal to tenants and shoppers alike. Portfolio occupancy has been maintained above the 98% mark and is a testament of our assets as a desired location for tenants. Remaining relevant to ever-changing consumer preferences through our experience-oriented offerings has helped tenant sales mostly recovering to pre-pandemic levels. Furthermore, the return of international visitors to Australia has helped in boosting footfall to the CBDs. Now, before I pass over to KS to talk about mainland China retail, I'll briefly touch on international office. The flight to quality thematic has caused further bifurcation in the pace of recovery since the pandemic. Our office assets not only stand out with their strategic locations within their respective CBDs, but also their high quality, as evidenced by the high occupancy rate of over 95%, and also a solid WALE of around 5.3 years. It is expected that the return of employees to the workplace will recover on a gradual basis, and the adjustment of the office sector is expected to be drawn out over the medium to longer term as tenants continue to assess their office footprint needs. I'll now hand over to KS. Thank you.
Thank you, Greg. Good afternoon to all. When we look across the border into mainland China, the slowing economy, weaker sentiments coupled with changing consumption patterns post-pandemic will impact the recovery of the portfolio. Rest assured, we are swiftly adjusting our tenant mix and marketing strategies. Occupancy rate stood at 95.8% thanks to our committed proactive asset management efforts. Portfolio rental reversion was a negative 5.2 coming out of COVID. If we exclude the two assets, Tianhe and Central Walk, which is under stabilization due to enhancements during COVID, rental reversion showcased a growth of 6.1%. Portfolio footfall and retail sales continue to demonstrate recovery, and now they have surpassed pre-COVID levels. There's a picture of the refreshed Link Plaza Tianhe. Link Plaza Tianhe, with an estimated capex of approximately 300 million RMB, achieved an ROI of about 12%. Is poised to leverage middle-class spending power in the mature Tianhe district. The grand opening is slated for 21st November this month. With a committed occupancy of around 95% as of 31st October, the mall has seen a significant 30% year-on-year footfall increase and over 50% year-on-year tenant sales surge post-reopening following the Mid-Autumn Festival and National Day holiday. We have introduced over 60 new tenants, over half of whom were first to the district of Guangzhou, with very positive reviews on social media platforms. The photos here give you an idea of what we have achieved with the AEI at Link Plaza Tianhe. Works on the facade, level 1, as well as works on placemaking have been done to uniquely position it as a hub showcasing a vibrant urban lifestyle, catering to the evolving taste of consumer and Gen Z. Its features include a designated play area for children, making it a family-friendly and inclusive destination. I also take this opportunity to thank our colleagues who successfully delivered this AEI through the pandemic. The 2 new properties were added to the logistics portfolio following completion of the acquisition during the first half. While Changshu North is still in the leasing process, our overall portfolio occupancy for logistics remains strong at 95%. Moreover, most of our assets include a rental escalation of 3 to 5%, and this mechanism ensures the stability of our cash flow, supporting robust growth for our portfolio. We will now shift our attention to capital management. In the face of a challenging macro environment, we have opted for prudence in capital management. Same as other REITs, despite the rate hikes environment, our average borrowing costs remain competitive. It's now at 3.74%. Furthermore, our financial strength is underscored by a healthy net gearing ratio of 18%, coupled with a solid EBITDA interest coverage of 4.3 times. We have also taken a step further by raising our fixed rate debt ratio to approximately 70%, placing us at the high end of our policy range. This will help protect us from higher or much longer rate environment. Our focus rests heavily on long-term value creation for unit holders. We are geared towards achieving this through various means that include unit buyback, dividend reinvestment scheme, and new investment opportunities. Following the rights issue exercise early this year, we have no refinancing needs until late 2425. This readjusts our balance sheet, offering additional buffer against high interest rates. This is further solidified by our well-staggered expiry profile with an average debt maturity of 3.4 years. Our average borrowing cost of 3.74% displays a more than 100 bps spread below the 3-month HIBOR and Fed Fund upper bound rate, which have both surpassed the 5% thresholds. Our current hedging policy of a high ratio of fixed rate debt is achieved through several debt instruments such as medium-term notes and our convertible bonds, as well as interest rate swaps. An element of natural hedging is also in place given the spread of debt across different currencies. On the income side, distributable income from overseas is substantially hedged every 12 months. Along the remainder of the right to proceed and our committed facilities, we have 22.8 billion Hong Kong dollars of liquidity on standby. Our A ratings with all 3 credit agencies remain intact, highlighting our solid fundamentals. This is evident in our key financial covenants, which are substantially below the requirements established and required by the 3 agencies. On portfolio valuation, our portfolio value declined by 3.5%. Apart from Singapore, most regions experienced varying degrees of cap rate expansions. The portfolios in Australia and UK faced the most increases. On the other hand, Hong Kong and mainland China experienced this to a lesser extent. The impact of the cap rate expansion was mitigated by our increasing rental cash flows, thus minimizing the drop of overall valuation. I'll pass the time now to George on our strategy.
Thank you, KS, and good afternoon, everyone. Let me present an update on our strategy. Currently, the Link REIT portfolio is skewed towards Hong Kong, followed by mainland China. Our international portfolio consisting Australia, Singapore, and the UK accounts for 11% of our portfolio value. Retail continues to be a heavyweight, accounting for 70% of our portfolio value. Over time, it is our intention to grow overseas. The rationale behind this is the benefit of diversification, which enable the REIT to ride different growth cycles across geographies and sectors. Targeted markets are Australia and Singapore due to the transparency and liquidity of the markets. Cap rate expansion in Australia has caused capital value to adjust downwards already, which could present us with opportunities, particularly where there is significant dislocation in pricing. This growth could be funded through capital recycling of portfolio assets or partial sell down of stakes to seed co-investments, which is also a segue leading into Link 3.0. I'll provide an update in our latest thinking about Link 3.0. Link has two businesses, a property ownership business that generates rental income, and an asset-light people business that focuses on fund and asset management under Link Asset Management Limited. Since IPO, we have done well with our property ownership business by delivering an annualized total return of 12% and a distribution CAGR of 10%. Meanwhile, our asset-light business, Link Asset Management Limited, has been dedicated to managing Link's asset and funds only. It is now a full-fledged fund and asset management business with over 1,300 people across the region that recovers its cost from its property ownership business. We think of our strategy in three parts: our asset business, our operating platform, and the fund management platform. Our property ownership business will remain our main driver of income, providing stable core and core plus return, while our asset-light business will provide us with a new S-curve for incremental growth. We'll remain fully dedicated to driving growth from our assets both organically and inorganically. With our operating platform, as mentioned by Greg, we will continue to enhance our operating excellence with our current platforms in Hong Kong, mainland China, and Singapore, and to look for opportunities to build our operating capacities in Australia and the logistics sector. It is envisaged that Link Asset Management Limited will develop capabilities to manage multiple platforms, including listed platforms and private platforms. And in recent years, we see more real estate investment by private capital rather than public equities. That's a shift that involves different return and thematic requirements. As we look into the future, we expect a shift in the global real estate capital landscape, gravitating towards high-quality asset managers capable of delivering consistent and superior returns, and we want to be one of them. We continue to focus on operational excellence in our capital, asset, and portfolio management to create unit holder return. We integrated our Singapore acquisition smoothly while continuing to drive the recovery of the organic portfolio. Our team has also been carefully managing our capital and financing to cushion the impact of a hawkish rate environment. While turbulent market conditions are expected to persist in the foreseeable future, we will continue to explore new growth avenues under our Link 3.0 strategy, while being cognizant of adopting prudence and patience in doing so. We remain committed to proving ourselves to be a trusted partner in sustainable growth, not only in the past but also for the future. Finally, here are the dates for payment of distribution with scrip election available and set out here for your information. Now let's move on to Q&A. Thank you.
Gentlemen, thank you for the presentation. We now move on to the Q&A session. So please raise your hand if you have any question. And before you ask the question, please identify yourself with your name and the media organization you represent. Media can also submit questions online. Also, due to time constraints, please limit your question to 2 each time. And questions pertaining to the financial results will be handled first. We will handle other questions later if time allows. So, any questions on the floor? At the back, the gentleman at the back, please.
Hello， 都想請教翻就係咧上半年見到嗰個續租香港嘅續租情況咧係都穩定啦。咁睇翻下半年咧個情況會唔會有啲唔同，或者可能因為見到嗰個經濟嗰個復甦啊，或者嗰個零售增長好似比想像中有少少距離。 咁會唔會喺續租嗰度會有啲唔同嘅情況？咁可唔可以 update 翻啦？第二都睇翻即係喺內地嗰度，我見到你哋嗰個即係續租或者嗰個表現可能會有少少距離嘅。咁會唔會話見到喺下半年咧個經濟開始慢慢復甦，都會有個好啲嘅情況？同埋都見到商場之間咧嘅競爭都幾激烈嘅喺內地。咁譬如深圳嗰度都見到都 keep 住都即係譬如幾個商場之間，你喺深圳嗰邊個附近都競爭得幾激烈下咧。咁個 vacancy 好似睇落去就會稍微高少少。咁而家個狀態會唔會好啲咧？咁而將來咧喺內地個 strategy 會唔會有啲變化
？Thank you. It's a long question. Chairman, about the operation question, shall it be handled by Mr. Chop and the financial one for KS?
So I'll take the reversion question first here in Hong Kong, if that's okay. So yeah, very pleasing first half at 8.7% reversion. We have undertaken a good proportion of the activity for the full financial year in the first half, so a good outcome. Your comments about the economic conditions in Hong Kong are well noted, so I can't see that the spreads or reversions in the second half would exceed those of the first half and may well moderate a little. But the lead indicators for us are very positive, that our portfolio occupancy at 98% continues to be at an all-time high. Our occupancy cost for our retailers at 12.4% here is very sustainable and a good position for both our retailers and ourselves for future growth. And our rental collections are in the very, very high 90% range. So all of those metrics give us a lead through to the positive, I guess, performance of our retailers, but I guess moderating rental reversions in the second half is probably the way that I would best explain it.
I think on the question of mainland China, observation across the borders in Shenzhen, I think a couple of observations as well as macro is that clearly we all can sense post-pandemic mainland has been trying to recover. Still a nice GDP number between 4 to 5. But underlying that number, I think there's a bit of confidence and shopper sentiment changes. We do see changes at the consumer shopping pattern. And clearly, if you look at Shenzhen, then there's the cross-border whereby many of us are going across on weekend due to the currency strength. Some claim a nicer shopping environment, better service, and to spend in Shenzhen. I think where we have come in terms of our strategy is there's a need to readjust the tenant mix. Clearly, retail is not as strong as F&B, experiential entertainment. I think where we were pretty fortunate was we did the AEI during the pandemic when business wasn't great anyway. Coming out of the pandemic, I think the hardware has been stabilized into what is good for purpose for business, and taking this opportunity, as some of you have seen in our malls, quickly fill it up with the right software of what the shoppers want. I think competition has always been difficult and tough in mainland because we are not as easy to urban plan as Hong Kong or Singapore, and supply does come frequently, and some of them are much better. But within our own catchment, I think our task remains to competitively beat up our competition, get the footfall in. I think the other highlight would be the footfall has actually come back to pre-COVID or even exceeding pre-COVID. It's just that the wallet spend and the type of spending has changed. So I think it's up to us, and I mentioned, is how do we use marketing strategies, fit in the right tenant mix, what the shoppers want, and continue to sweat the shopping mall on a per square foot sales basis to try to get back the results that we are all hoping for.
Thank you. Any other questions? Yes, lady in the front.
經濟部我想問下，即係上次業績會嘅時候，即係CEO 都講過，即係而家喺併購市場個買賣雙方嘅差價就比較大啦。咁其實我話即係過咗半年之後，即係其實見到喺併購市場嗰度，即係呢一個差價有冇收窄到咧？即係領展喺併購嗰方面個部署有冇唔同咗咧？ 另外就想問翻，即係都見到港人即係北上消費都增加咗好多啦。咁其實領展喺內地個商場有冇話即係港人個消費嗰個佔比係幾多咧？咁如果譬如話喺香港個商場，即係領展有啲咩方法，可能即係可以留翻啲香港人喺香港消費，即係帶動翻嗰個銷售額咧？唔該。
差價即係去睇收購咧，其實相信嗰啲機會係未來幾個月會多啲嘅，因為已經一個持續一段時間係高息啦，咁相信有啲業主啊、啲投資者啦，都開始去到一個位置位啦，佢哋有可能會個價錢會調整嚟出售咯，咁所以我哋睇得到多咗項目去睇嘅，但係當然我哋嘅成本亦提高咗，咁所以我哋要求可以達得到嗰個投資目標咧，亦改變咗，咁所以都仲陸續有睇緊項目，但係就未有嗰個可以公佈得到嘅啲成績啦。至於香港嘅消費者入去國內咁，我諗中心城係一個好好例子啦嚇，即係喺福田區高鐵站嗰一條街咁，我哋都有成30幾，差唔多40%嘅消費者喺嗰個商場係香港人嚟嘅，咁因為有時候睇啲數碼數據支付嘅平台都得攞到啲數據睇得到係好多香港人上咗去，咁我哋當然亦有啲優惠。至於香港嘅商場，我哋真係要做翻一啲係適合有時候唔係一日走咗上去深圳或者廣州附近，即係呢個消費方便嘅即係日常用品呢啲咁，我哋希望可以繼續提升，令到咧有呢個吸引力。咁當然即係如果話一家大細走上去做一日嗰個活動嘅話，咁希望香港亦多啲呢一類嘅活動留到香港人喺香港消費啦。咁另外嘅就係嗰個人民幣，因為始終弱咗，咁變到國內消費者嚟香港消費嘅意欲係降低咗，咁所以呢個都要等呢個環境去調整翻先會吸引得到多啲人嚟。
Thank you. Yes. 中間位同事。
你好，我先到日報嘅，想問下有關於領展就想發展呢個輕資產第三方管理嘅業務咧，可唔可以講下個例子係例如係邊一類嘅業務啊？見到之前嗰個收購新加坡都有個資產嗰啲物業管理嘅服務，係咪就係你哋第一次做嘅呢一個嘅範疇啊？咁呢個輕資產模式裏邊包唔包含出售而家現有嘅資產，然後就嚟套現，即係可以增加翻個資產負債表咧？特別係香港嘅資產會唔會有呢個出售機會？另外第二樣嘢想問翻咧，就係最近呢2-3個月啦，政府就積極推出咗夜市嘅經濟啦。會唔會見到其實而家香港零售資產組合方面，其實嗰個消費嘅週期可以延長翻夜市嗰邊，其實有冇個復甦嘅跡象咧？唔該。
呢個第三方資產管理，咁新加坡嗰個就係幫當時嘅買家去管理佢嘅商場啦。咁另外嘅就係其實去管理嘅唔止係個商場啦，因為我哋睇緊第三方嘅資金嘅管理啦。咁呢個我哋考慮緊唔同嘅方案啦。如果新嘅投資譬如新加坡嗰幾個物業投資嘅時候，當時我哋都有考慮過係咪引一啲其他嘅資本基金入嚟。咁當時我諗個市場環境改變之後，咁我哋冇繼續做啦。我哋自己擁有嘅物業將來會有可能考慮下，就唔係100%咁賣咗出去，有可能賣一部分咁，然後持續擁有一個細股，然後繼續去管理啦，或者 我哋去投資嗰時候，繼續好似我哋之前考慮咁樣，就帶一啲其他嘅資本基金一齊嚟投資。當然去到另外一個程度嘅就係有可能去再有一啲其他嘅基金，一啲私募基金類似嘅投資嘅項目，我哋可以自己去設計，然後去推出。咁呢啲都係我哋一直喺度準備中咁有可能都要啲時間。夜市great.
Yeah, we're participating in a number of activities across Hong Kong. One of our most recent activities was a nighttime cinema at Lok Fu, and there's a number of other initiatives that we're undertaking. And probably just complementing the comments on Singapore, one of the things that is important to note with our acquisition in Singapore is that it came with a very good and experienced team of 130 executives there. So we've got a very strong capability in Singapore that complements our capacity and capabilities here in Hong Kong.
I'd just like to supplement there, because I think it comes back to the comments that were made earlier about what's market sentiment at the moment. Are transactions going to be coming back into the market? Your question about the difference between buyers and sellers' expectations. We've now had higher for quite a length of time. I think we're going to have higher for longer. That would be my view. And as that maps out, I think that pain in certain areas is going to increase. So my view is that we are going to see prices get a little bit more sensible, and that is what we have been waiting for. Having done our rights issue, having had cash to one side, we're trying to look at when is the right time to come back into this market. And we said to you 6 months ago that we were waiting, and we are now. But I personally feel that is getting closer, and I think you would all know and have views about what pain is out there in the marketplace. And that's also very important for our aspirations in third-party capital, because in order to raise funds, you have to have a meeting of minds about what returns can be generated, and those are ultimately price-based as well. So from our point of view, I see next year as an opportunity year, and I see that there will be opportunities for us, both M&A and in Link 3.0.
Thank you. Any more questions? Yeah. So it will be 2 last questions. Yeah.
係你好，咁想問咧，頭先就話即係出年會有一個可能收購嘅一個機會嘅一個年份啦。咁但係睇到其實就話係咪現有嘅一個資本基礎之下，其實都afford到即係而家睇緊嘅一啲 project 咁樣咧？因為見到話可能預計即係出年底前都唔使再進行再融資等等。咁係咪依家嗰個資本基礎其實已經足夠到集團去睇翻依家入去收購嘅項目咁樣咧？
Short answer is yes. Our gearing, as KS explained, is running at net basis around 18% at the moment. And you also will, I'm sure, appreciate that part of our strategy is to co-invest on assets as well. So when you bring in the firepower that comes with co-investing, plus generally the significant firepower that we have at an 18% gearing, I have supported my short answer, which was yes. And I think the gentleman here with the headphones had the second question.
Yes.
幾位你哋好，香港電台記者 Gary， 咁有2個問題嘅。咁第一都係問宏觀少少咁其實都講緊嗰個零售銷售嘅數字喺9月喺香港整體個環境咧，其實嗰個增速其實都放緩緊嘅。咁啱啱其實討論到關於北上消費嘅問題，其實你覺得會唔會喺今年甚至乎喺出年會繼續影響到即係成個市道嘅復甦，同埋甚至乎即係公司嘅業績喺下半個財年，其實嗰個收益其實會唔會都可能有啲影響咧？ 另一個問題咧就係關於喺今年嘅時候咧，其實都有一啲天雨嘅災害啦。咁領展旗下譬如喺柴灣同埋黃大仙兩個商場，其實都受到一個水災嘅影響。想問下，即係其實公司喺當中嘅損失有幾多，同埋即係涉及嘅保險賠償嗰方面，其實係咪已經做好咗咧？咁譬如租戶嗰個有冇話一個免租期，其實係長咗幾耐？咁未來會唔會需要再做一啲資產提升嘅工程？其實涉及嗰個開支大概幾多咧？唔該。
我等Greg 去答下個黑雨嘅問題啦。咁宏觀嚟講，我諗香港始終經濟環境都持續係好好嘅。咁經濟嘅增長啦，個失業率仲係非常之低啦。人工又繼續即係喺唔同嘅行業都仲係有增加啦。咁當然最低工資亦有增加。咁所以對於香港本土嚟講，嗰個零售嗰個動力都仲喺度。咁當然即係我哋啲商場好少係國內嘅消費者，咁但係即係如果佢哋嚟香港消費嘅，間接都會帶領到我哋嘅消費。咁所以呢個我哋都希望快啲見得到多翻啲遊客尤其是國內嘅消費者落嚟香港。咁但係整體嚟講，我哋覺得都係正面啊，睇唔到話即係太大嘅挑戰啦，同我哋嘅租客傾頭先啦，都係講過，我哋嗰個租金同營業額嗰個比例都仲係大約12%度，咁都係一個即係較為合理嘅一個水平。Second half.
So for the second half, the performance of the second half, revenue continued, I guess, position to what we've just reported for the first half. We don't see there to be any change. I think one of the things that we're very, very focused on, given we are in an inflationary environment, is managing the operating expenditure on a day-to-day basis across our portfolio to mitigate any impacts of the inflationary environment. So more of the same is probably the best way to explain it. The thing to point out is that we're very focused on everyday needs and non-discretionary retail. We always have been and we always will be. So well over 60% of our trade mix is associated with food and food-related categories. So we're very much here to service the day-to-day needs of the local Hong Kong population. Your other question with regards to the Black Rain event, so obviously we had issues at Temple Mall North where the lower ground level was inundated. That impacted 8 tenants. We are supporting those 8 tenants and they are all in the process of refitting their premises as we speak, and we are hopeful that they will all reopen for business well before the end of this calendar year. So hopefully progressively from towards the end of November into early December. With regards to the total loss, we've gone and taken proactive steps to refurbish the area, and as we noted in that video we showed earlier, on the 31st of October, the last piece of that for us was turning the escalators back on, which we were very pleased to do. Now we're just working through the insurance claim. We don't believe that there'll be any impact to us, as we have appropriate insurances across our business. So I'd like to just call out the efforts of all of our operational teams that worked tirelessly over a matter of 50 odd days to get back to the position that we are, and we've worked very proactively in partnership with our retailers to bring them back to where they are. So hopefully that answers your question.
Thank you.
我做一個好簡單嘅總結啦，即係我哋喺開始嘅時候有一個 slides 俾你睇得到，我哋每一年嗰個總派息係一直咁持續增長。咁我哋嗰個專注力管理層嘅專注力都繼續，希望可以繼續做到呢一樣嘢下條有呢個上升。咁當然過去呢幾年疫情各方面咧都影響得到個市道，咁但係我哋都可以保持做到呢一樣嘢。咁當然其中一個好大嘅動力就係我哋已經係有呢個地理上嘅一個分散投資啦。咁我哋會繼續去行呢一個方向。咁希望去到Link 3.0做 三方之間管理嘅，咁亦都俾到我哋一個更加新嘅一個動力。年初做咗個供股，咁當時有各種嘅唔同嘅意見啦，咁但係我哋起碼即係用咗過去呢幾個月睇得到利息持續嘅高企咧，係對於我哋喺資本管理方面做咗供股係正面嘅。咁我哋而家係唯一嘅就係考驗大家嘅耐性啦，我哋嘅耐性啦，去喺一啲適當嘅投資咁嚟好好利用到我哋供股攞翻嚟嘅資金啦。咁相信我哋嘅單位持有人要求我哋做嘅就係好聰明咁去用，就唔係淨係話好快咁去用咯。咁所以我哋有咁嘅需要俾啲耐性去睇一啲好嘅項目，或者好好回報嘅項目，我哋先會去投資咯。咁即係我諗呢個準備喺年初到而家睇得到。如果真係好似頭先主席咁講，我哋嘅睇法 high for longer 利息持續一段長時間咁高企嘅話咧，相信對於好多其他嘅投資者都有影響嘅話咧，我哋係一個非常之好嘅一個位置去議價去考慮希望可以收購得到呢啲非常之好嘅項目。多謝大家。
Thank you. Thank you. This brings to the end of today's news conference. Thank you very much. Thank you, gentlemen.
好啊，領展中期業績發佈會嚟到呢度啦，心靈港島香格里拉大酒店現場嗰度。